This is InvestTalk, independent thinking, shared success.
Hi, this is Van from Idaho. I have a question on whether you think that DVN Energy, symbol DVN, is a good buy at this time or not, and what a good entry point is. Thank you very much. Love your show. Bye.
All right, looking at DVN Energy, and this has been in a downtrend, mainly because oil prices have been in a downtrend. So it's a large oil producer. Earnings are expected to go from $8.31 back in 2022. The Ukraine war, high oil prices, etc. So that was kind of an anomaly. It fell back to $5.71 in 2023, then $4.82 last year, and this was to fall to $3.87 this year. So clearly earnings are in decline. So it's all going to depend on where you think oil prices are going to go. Now, the biggest issue with DVN Energy is not in its assets, it's really in its liabilities. It does have a good amount of debt, about $9 billion in long-term debt on a $19 billion market cap. That is a bit of a worry, and the free cash flow is now negative. So that's why it's in a downtrend. That's the worry here. So it's a high-risk play. It's a high-risk play that if oil prices rebound, this will probably do much better than most of the oil majors. Okay. And this is your pure play E&P company, both the United States and Canada. So domestic producer here. Revenues were up 24% last quarter. Earnings are up 4%. So clearly they are doing some good things with production in the midst of a downtrend in prices. So that is the positive here is, once again, their assets are solid. It's just that liability side that is really weighing on the stock. So is it a good buy here? It all depends on oil prices. And what's interesting to me, if you look at oil was up today. It did fade throughout the day, but it was up. And with all the bad news around OPEC new supply and all this, there wasn't a new low in oil prices. And to me, that is a relative positive for the oil market. That you had bad news and that did not really hurt the price. Back in May, you had the OPEC new supply announcement, all of that. And initially the market fell, but it rebounded the next day and headed higher. And so I generally like those situations. You've been in a long downtrend in any asset, you have bad news and it doesn't go down anymore. It usually means there's not a lot of weak hands left. They've all kind of dumped those type of companies. So it's certainly on the cheap side, trading at about 8 times forward-looking earnings. And so I'm going to say I think it is a relatively good time to own DVN. However, it is high risk. So know that it is very high risk because of that debt. Thanks for the call. Now, let's go tackle a YouTube channel question from Mr. Houston 55. Says, hey guys, another informative podcast. I'm considering taking a position in Caterpillar. What do you think about the stock and what might be a good entry point? All right, let's take a look at Caterpillar. Obviously, one of the largest, very cyclical names, about $164 billion market cap, but over the long term, their business is fairly cyclical, and it's in a downtrend right now. Downtrend in cyclicality. Revenues are down 10% last quarter. Earnings are down 24%. This year, earnings are supposed to fall 14% and then go back up 12% next year. But both of those estimates are being revised down on average. So you don't like to see that trend. Relative strength is 51, so it's kind of in the middle. It's not doing great, not doing terrible over the last year. For everyone else, they manufacture construction and mining equipment, diesel and natural gas engines, turbines, locomotives, etc. So a very good business, but the problem is that it is in that downtrend. And until it breaks that downtrend, I would pass on Caterpillar. It's below the 200-day moving average, and it would need to recapture that for me to get excited on it. And until then, I'm passing on Caterpillar. CAT. Let's go talk to Don from Orinda and let's talk about bonds. Listening on the podcast.
Yes, sir. I have, or my wife has, an inherited IRA We've just determined on how we want to take distribution of it over the next 4 years. Right now, it is sitting in SGov because I didn't know what to do with it. And so I was about to go purchase some bonds out. I was going to ladder it over the next 4 years because that's when we'll be taking the money out. SGov right now has an interest rate of 4.7. Over the next 4 years, all of the rates, this money is my wife's, and her level of conservative is ridiculous as far as the money goes. So everything goes into CDs. But anyway, so I'm looking at locking these in at whatever rates, but they're all under, either at or under 4.7 that ESCO has. Considering you're pretty convinced, or the analysts are pretty convinced that there will be a couple of rate cuts, do I just go ahead and lock this in, or do I see if the rates fluctuate? Or what would you recommend? I have 4 years here that I need bonds for.
So the first thing is that you need to understand how to look at the yield for SGov. It is not 4.7. Now, trailing 12 months, it is 4.7. But that's trailing 12 months. That includes a period where rates were higher, right? The Fed started cutting rates, what was that, 6-9 months ago, something like that. So there was a period where it was paying more. If you look at what is called the SEC yield, you want to look at the 7-day SEC yield, especially for any of these money market-like funds, like an SGov. It's actually 4.17. 4.17. Okay. So still, decent, but not 4.7. It's 4.17. Okay. Now, I like the idea of what you're doing is trying to ladder out the bonds in order to align with when you're going to take the money out. I think that's smart. And then it goes down to, okay, what will Fed policy be going forward, and how much will rates kind of fluctuate? So typically the Fed follows the 2-year Treasury, okay, the 2-year Treasury rate. Now, if you look at the 2-year Treasury rate, so it's at about 3.92. Okay, so it's saying that the short-term rates are going to head on average over the next 2 years down only slightly. So the market's not really pricing in a bunch of Fed cuts. And you could easily see, I could see rates going up. It's not out of the realm of possibility that we continue to see dollar weakness, that we continue to see tariffs creates an inflationary environment, that you get stimulative moves both out of the Fed and the Treasury, right? With the spending bill, if the Fed, or if the spending bill is as big as it is now, that's going to be inflationary. It's a lot of spending. It's kind of like what happened back in 2021, 2022, when the government was irresponsible and spent too much. And so I don't put that out of the realm of possibility that the Fed is actually has a U-turn and rates go up. So it's kind of a murky picture because you don't know how all these things are going to really feed into Fed policy. Now, so it also depends on, are you looking at treasuries? Are you looking at corporate bonds? What type of bonds are you looking at?
Oh, I'm sorry, CDs.
CDs. Okay.
My wife is extremely conservative, and she says CDs, and that's period.
Okay. So why CDs over treasuries? Going to buy 1 year, 2 year, 3 year, 4 year treasuries?
A treasury, I could do that as well, but CDs were actually a little bit better than the treasuries.
And what state do you live in?
That would still be okay.
And what state do you live in?
Excuse me?
What state do you live in?
In California.
Okay. So pretty high tax state. I live in California as well. And are you in a relatively high tax bracket, middle, low?
I'm afraid, yes, in the high tax bracket.
Okay.
But again, this is an inherited IRA.
So I see.
Until I
Got
take it out.
Got it. So yeah, there's no no tax implications here. Sorry about that.
Right.
Yes. So if you can get higher than treasuries on the CD, that's probably what I would go with. But I would go look at that, relook at the yield curve, what you're getting on CDs. What are the CD rates right now that you're seeing?
4.7 was one that I looked at about 4 years out.
Okay.
I'm not in front of the computer right now. That was just off the top of my head.
Okay. Then then I would go with that. I would go with that.
If it was lower.
Yeah, I would go with that. If you can get 4.7 kind of on average over the next 4 years, FDIC insured, you don't want to take risk. That's a good way to go for that type of money and laddering those out.
Fantastic. Thank you very much.
No problem. Thanks for the call. Now let's tackle 2 in a row. The next question came from Georgia.
Hey, this is James from Georgia. We were trying to call you guys to ask you about ticker symbol DG. That's Dollar Gentry. You're trying to find out if it's at all a good time to even try to enter this stock, because I know it's at all-time lows. We appreciate the answer, and we'll listen to the show. Thank you.
All right. Thanks for the call. Looking at Dollar General, DG is the symbol. And this is a name that has been down on its luck, but it looks to be bouncing back. Free cash flow now about $1.7 billion. And it did about middle of 2023, it dipped down to a barely positive, only 93 million in free cash flow. So we're back to 1.6. That's pretty good on a $21 billion market cap. So you're talking about a 5-ish, maybe a little bit higher than that, maybe a 7% free cash flow yield. I like that. Then if you look at earnings, let me pull up earnings here. Earnings this year are supposed to bounce back 10%. The earnings were $10.68 at the peak of COVID, when everyone was getting stimmy checks and they're going to spend that at Dollar General and other retailers. They were crushing. But you had that mean reversion. Earnings back down to $5.11 last year, down 32% from the year before. And it's supposed to be back up to $5.61 this year. So I like that we're getting back to profit growth of 11% earnings next year. Those estimates are going higher as well. And you're trading at about 15 times forward-looking earnings. That's pretty good. Historically, it's a very solid business. So I'm going to give Dollar General a thumbs up. I think the balance sheet is fine. The cash flow has returned, and they're right-sizing their business. So I'm going to give Dollar General a thumbs up. Thanks for the call. Now let's talk a little bit about the model that really has existed since the Asian financial crisis, and especially when China entered the WTO. And it was really all about Asian exporters selling goods to the US, taking those dollars and investing them back in the US, in US equity markets and bond markets. But now that we have the new Trump administration trying to remake the global economy, there's about $7.5 trillion of US investments held by Asian countries. And that is at risk of being diversified out. And a big part of this is the sell-off in the dollar that was going these investors' way for a long period of time. Dollar appreciation compared to Asian currencies because of our strong economy, us being the world's reserve currency, etc. But that, once again, is starting to reverse. And you're seeing things like Taiwan insurers reporting big losses because of the dollar sell-off. You also saw the Taiwan dollar surge recently in fear that there would be some sort of accord to weaken the dollar against these Asian currencies during these negotiations, these trade negotiations, etc. Now, even before Trump came in office, though, capital flows from Asia were slowing dramatically, especially after the yen carry trade unwind last year. Remember last summer when you had the big sell-off? And you had Japan's largest life insurer starting to think about diversifying out of U.S. bonds, Australian pension fund declaring a peak in asset allocation to the U.S., and they have $96 billion to invest. And the latest data as of March says China's treasuries also shrink. So all of this is, once again, being accelerated under this new Trump administration. And so it's the yen carry trend unwind, when the yen rallied dramatically and the dollar sold off dramatically against the yen. These were kind of warning signs that looked very similar to what was happening in the Asian financial crisis back in 98, which really sparked all of this move towards US dollar assets that really that event kind of scared them into holding too many domestic assets. They wanted access to dollars so that they didn't have a dollar shortage. So you own dollar assets, it's easy to go get dollars, right? And there's a growing list of worries from these investors. You're talking about growing budget deficits, political polarization, and aging infrastructure here in the United States. Then there's these sanctions on Russia and the fact that that we just confiscated the assets. And the worry is that if there's some sort of war breakout between China and the United States, or just some other geopolitical event that we don't like, hey, we can take their assets as well. So diversifying out of U.S. assets is prudent at this point. And so they're going from hoarding dollar assets to really diversifying away. And collectively, the 11 biggest economies have about $4.7 trillion in U.S. equities and bonds. They put that much in equities and U.S. bonds since 1987. And with growth of those assets, total about $7.5 trillion. Now, what's interesting here is annual flows peaked in 2004. So it's actually been slowing since then. And 2008 was a real big wake-up call. And as of 2024, the inflows dropped to only $68 billion, making up just 11% of our trade surplus. So they've slowly been diversifying, but now this is an accelerant to that diversification. And if you look at parity, the trading parity of the dollar on average, the regional currencies, the region's major currencies, thinking the yen, the yuan, etc., they're trading about 57% weaker than the exchange rate would take into account with the cost of living differences. So purchasing power parity. So really, the dollar should weaken by about 50% compared to these currencies over time. And that's where the problem lies. And that's why you're likely to continue to see more and more of this diversity and dollar weakness. And it makes those foreign assets start to become more competitive and more attractive. Let's go take a live call. Richard from Valencia looking at FLJP.
Yes. Hi, Justin. I've in listening to the show and, talking about the idea of diversifying outside of the United States as well into international equities and so forth. Heard you talk a lot about Mexico being high on the list in terms of a priority. Talked about Europe. But what about Japan? It's been 30 years of, economic
malaise
issues and so forth. Mm-hmm. Yes. But what about at this point, in terms of a long-term portfolio, getting into Japan with a Japanese ETF such as this Franklin Japan ETF FLJP?
Yeah, I like the Japan exposure. It does have its issues. It does have a lot of debt to GDP, high debt to GDP ratio. The thing is, though, it owns a lot of foreign assets. So, think of the largest holder of our treasuries, for example, along with other assets. So they're able to liquidate those assets to stem the tide of currency depreciation, which they've done as of late. And the yen is starting to strengthen. And certainly that's helping those Japanese assets. So I generally like that. I like the exposure to Japan. You have a P ratio around 13. They're doing a lot of corporate reform there, price the book around 1.2. So I think this is a good portfolio diversifier. It has good rule of law. They do have issues with demographics. They do have a lot of exposure to for energy, right? Now they're relaunching their nuclear facilities, so that's helping them. But they do import a lot of raw materials because they are a string of islands, and so there are issues, but there's issues with every country. But generally, I like the valuations here, and I'm a fan of exposure to Japan. Thanks for the call.
Hey, Dan from New York. Just a quick question, long-time listener. Congrats on all the success, but just wondering what your thoughts are on gold right now, GDX, GDXJ, maybe SLV too. Thanks.
Well, I still remain bullish on gold and silver, gold miners, and that's because just the fiscal path that we are on is unsustainable, and it's clear that neither party wants to truly address it. You have the last many administrations that have just grown the deficit exponentially, and it's not. And I don't want to say administrations because remember the power of the purse lies with Congress. So it's really the group of a few hundred politicians in Washington that are not doing much about this, and they're finding every excuse in the book to continue on this reckless path. And even with this administration talking about DOGE, right, Department of Government Efficiency, and I said this early on when Elon was announcing these cuts, was that all this has to be done by Congress, ultimately, for the most part. And you can see that with this bill, that almost none of what Elon had talked about is being ratified in the spending package. And so while it's all well and good to talk about it, ultimately it has to be done. And that's not happening. This is going through the Senate. Maybe there's a few staunch Republicans that step up. Unlikely, I think. And unlikely for our fiscal house to really get in order. And the longer it takes, the harder it is to get out, because we know that every second, every minute, every hour, every month that goes by, billions and billions of dollars are being added to the debt. And power of compounding, very simple. It means that this is a runaway train. We are in fiscal dominance. And the outlet for that is gold and silver. Harder assets. Anything that's hard, there's a reason Bitcoin is going up. I think there's some problems with that whole system, but at the end of the day, it does have a correlation to fiscal irresponsibility. Now, gold and silver to me are a better bet, especially with the lack of allocation that's out there and the increase in allocation that's coming from Asia. And new banking rules allow banks to hold gold and silver and use that as a basis for lending. And I think that's going to be a big driver over the long term. And I just think that nothing stops this train, because they've been talking about it for years. And even, President Trump ran on this in a big way. And clearly that is not happening in any way, shape, or form. And the release valve, once again, are the harder assets, probably weaker dollar. And they could easily see gold and silver, gold being above 4,000 an ounce by sometime next year. And this thing could get exponential. That's going to be volatile. There are going to be big drops along with big rallies. But if you look lately, it's just been orderly. You had that Barron's cover that kind of marks sentiment where it talked about gold and silver. That does typically lead to short-term weakness, and you got that over the past month or so. But now over the last week, it's resurging higher. And so the pullback was just an orderly one to the roughly 50-day moving average, and the uptrend remains intact. So I see no reason to get off this train because I think the train keeps moving forward. Well, that about does it. That completes another InvestTalk program. Appreciate you all tuning in. And you can find our free episodes anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes. And if today's show made you think about your broader financial picture, your investments, taxes, retirement, and whether it all really is working, let's talk about it. At KPP Financial, we offer a no-cost portfolio review to help bring clarity to your risk tolerance level, your risk capacity, as well as the current risk in your portfolio, so you can have clarity and confidence going forward. So just head over to investtalk.com, click on portfolio review. Independent thinking, shared success. This is InvestTalk. Good night.